All right, everybody, welcome to the show, you magnificent monsters of the market. Grab your caffeine of choice. I've got this ultra wild passion because I got a passion for the stupidness that's going on in the market and making money from it. So while you were sleeping, Jamie Dimon, the guy running the biggest bank in America, Chase, JP Morgan, anybody heard of it? He rang a bell, and this is not like the opening bell to the New York Stock Exchange or something like that. No, no, no. He rang a very distinct warning bell. The same kind of bell that rang in 2005, rang in 2006, rang in 2007, right before everything came apart back in 2008. During the Great Financial Crisis or Global Financial Crisis, or you decide what GFC stands for, but financial crisis. And he got on a call with investors, and in a classic folksy, but I'm smarter than everybody listening kind of way, he said, and I quote, "I see a couple people doing some dumb things, and they're not just doing dumb things to create NII. Now, what the fudge is NII? For those that maybe don't speak Jamie Dimon or Wall Street banker or banker at all, NII is net interest income. So this means that he was saying that there's people, when he says a couple of people, he probably means dozens or hundreds of other banks and financial people chasing pennies to get net interest income, doing dumb things for pennies while standing on the financial railroad tracks with a high-speed train full of dynamite, cruising by the nitroglycerin factory, coming right at you. Because dumb things, as Diamond put it, and that he was talking about, they created a trap. This is a trap that I've talked about already. I'm going to call it the liquidity illusion right here. Now, for the last decade, you've been told that you can buy and sell trillions of dollars of corporate debt instantly through ETFs, and that's the illusion. The reality is that the traditional buyers, the big banks, they've actually gotten out of this market. They've vanished from the table. They've been replaced. And this is what I've been warning about. Like, see the same things happening, these same ETFs being created. That was all the same stuff we were doing in 2005, 6, 7, 8, except now they're in ETFs, and now all these ETFs are using our money to do this. And they're using retail money. They're not using big bank money. So the big banks were using their own money before, and they got together and they said, hey, you know what? We can do the same game, but if we put it in an ETF, we can use everybody else's money, not ours. And you know what? We've got retail investors piling into big bond ETFs like LQD, HYG, and we are the market. And when the panic starts inevitably coming apart, and there's dozens more, everybody rushes for the exit at the same time, and there's not going to be anyone left to buy when you're desperate to sell if you've got exposure to these things. And that's when the prices don't just go down, they gap down, and your portfolio evaporates overnight if you've got exposure to this. You should check your 401k. Maybe that's one of the things that they have you invested in, if it's managed by somebody like BlackRock or whatever, because that's where they want that's what they want to do. They want to put your money at risk in this stuff, not theirs. I knew that was coming. Anyway, excuse me. So this puts it in a tough spot, right? The Fed, well, the traditional think the Fed has to come in with another multi-trillion-dollar bailout funded by your future and just to float your IRA and keep everything going, keep your 401k going. And this isn't really a fire drill. The canary in the coal mine died, right? I've already talked about it on the show many times. If you're new here, make sure you subscribe and chat with us on the live stream. Maybe hit the bell and the notifications and come back. I mean, I talk about this stuff all the time. So let's rewind the clock a little bit. Back before the great financial crisis or global financial crisis or whatever you want to call it in 2008, the big banks, the JP Morgans, Goldman Sachs, the world bankers were the price makers in the corporate bond market. They were the foundation, the market's foundation in this market for bonds. They held hundreds of billions of dollars of this kind of stuff on their books, over 300 billion to be exact, when we look at the historical breakdown of it. When there was a little bit of turbulence, they had the incentive and the capacity to step in, buy the dip, stabilize things. They provided some liquidity. They were adults in the room of ridiculous bonds. But after 2008, the regulators came in and the Volcker rule happened, and they said, you know what? That stuff's too risky. No more fun for you. And there were other regulations along that basically forced banks out of the business of holding corporate debt, which it was really mortgage-backed securities that caused the problems in 2008. But, it all gets commingled and intertwined, and it was really the mortgage-backed securities, but the bonds that Enron and other players like that were creating that then got put on the books for banks that caused all this hiccup. It was a complicated story. But the regulators came in and said, yeah, you know what? Let's just play it safe. Let's just keep you from putting corporate bonds on the books, which AAA rated collateralized bonds are probably one of the safest places to park your money. We've never had a AAA rated company ever go bankrupt in this country. So the holdings of bonds have collapsed from 300 billion to just say around 70 billion right now today. Been put out of the game, put on the bench, and not likely to go back in the game, at least under the current rules. So who picked up the slack? Who now owns all this corporate debt? Why, you do. You do, and probably in your 401k, and every other investor who owns a corporate bond ETF. Today, ETFs hold a staggering $1.25 trillion with a T in corporate bonds. That's actually 25 times more than the dealers who are supposed to make the market work. Think about this. The banks, 70 billion. You and I, our 401ks, the managed funds, holding $1.25 trillion in corporate bonds. So here's the terrifying part. ETFs, they're the price takers, not the price makers. They don't think. They don't analyze. They don't try to get a great deal. They just buy. They buy whatever bonds they need to satisfy their underlying index. And they sell whatever bond. They don't try to get a great price when they sell either. So they don't really care. It's not their money. They get the fees regardless. It's a beautiful, crooked system. It's rigged against us who are passively buying the stuff in our 401ks as we agree to put so much percentage toward bonds. And when investors get scared and start selling their ETF shares, maybe getting out of their, moving their 401k into something else, the ETF manager has no choice. Sell the bonds, sell them into the market, raise cash, whatever price. But if the original market makers, the banks, aren't there to buy, who are they actually selling to? Other 401k holders, other ETFs. Well, it's kind of a snake eating its own tail. It's an illusion of liquidity that only works when everybody's calm. The moment that fear starts shaking or some hiccups happen in the markets, well, everything's a house of cards. We saw a preview of this movie not too long ago. I guess it's getting to be 6 years ago. March 2020, when COVID panic hit. These supposed liquid bond ETFs even, started trading at massive discounts to their actual value. The plumbing of the market broke, and the only reason the whole system didn't actually implode was because the Federal Reserve stepped in and, for the first time in history, started buying high-yield junk bonds and ETFs and put them on their balance sheet. They became the buyer of last resort. Now, this stage is now set for an even bigger crisis, and the catalyst, as Dimon outlined, is actually AI. It's all a giant bubble, kind of, even if you don't want to call it a bubble. There are problems, there's cracks, this is going to result in some sort of flush out. For years, the hottest area in private credit, a $1.8 trillion market of loans to private companies, has been software as a service, or SaaS. These were seen as perfect borrowers, high margin, recurring revenue, sticky customers. Business development companies, or BDCs, which are basically publicly traded private equity funds for debt, have gorged themselves on these loans, these bonds. About 20% of the entire private equity credit market is loans to software firms. I've talked about this. But suddenly, AI enters the room. The game has been changing. New AI coding agents can build software for a fraction of the cost, commoditizing what used to be protected monopolies. The moats around companies like Salesforce, Workday, DocuSign, they're evaporating pretty quickly as their business comes under pressure. Their ability to pay back these massive loans and bonds suddenly thrown into question. The first crack has already appeared. Just last week, a major player in the space, Blue Owl Capital, their ticker, OWL, they halted redemptions. What does that mean? It means you can't get your money back. This is one of the giant private credit funds out there on the market. They sold this fund to regular investors like us with the promise that you can get your money out anytime you need to. But the loans inside that fund are locked up for 4, 5, 6, maybe longer years. It's a classic liquidity mismatch. Liquidity promises backed by liquidity. I guess they're not really liquidity assets. They're illiquid assets. There's no buyers for them. I mean, this is kind of like the first domino in the chain. So how do you play it? How do you profit from potential chaos like this? This is where we put on our monster hats or grab our monster drinks and we don't panic. We position. If this is a sector that kind of perks your ears up, an opportunity, you got to identify ground zero. Where is the highest risk BDC? Which ones have this heavy exposure to tech loans? And there's some of them that are using leverage, like Prospect Capital, PSEC, Oxford Lane Capital, OXLC. That's Papa Sierra Echo Charlie for Prospect Capital, or Oscar X-Ray Lima Charlie for Oxford Lane Capital. These are ones to avoid. They have leverage bets buying these bonds in the software as a service space. Now, if you have the stomach for it, you could potentially bet against these guys because, well, the unwind is going to be vicious. But the real opportunity is in using one of my favorite strategies. It's one I don't even sell. I call it the turbo wheel. Now, we could sell cash secured puts on the highest quality names in the sector, collecting fat premiums from all this fear. One that might work in a space, Ares Capital, That's Alpha Romeo Charlie Charlie. It's one of the largest and best run BDCs with a diversified portfolio and a juicy 9.5% yield. As I'm looking at that right now, you could potentially sell a put maybe 5 or 10% below current price and collect premium that works out to over 100% on an annualized basis. If the stock drops, you get a sign, you're in that BDC. Now you own a quality income name producing asset at a pretty fair discount with a yield on your cost basis over 10%. Maybe it's a thing you want to look at, maybe not. If that's too spicy for you, though, maybe you want to stay out of the BDC arena. There's the ironic trade. JP Morgan. That's Juliet Papa Mike itself. Dimon is telling you a storm is brewing. It's coming. So would you buy into his fortress? Do you think he's immune to this? JP Morgan has the strongest balance sheet of any bank, at least by the government measures. And potentially he's going to be at a flight to safety destination when the credit markets freeze. You can sell puts on JP Morgan, collect a smaller but still very attractive premium with the peace of mind knowing that you're betting on one of the stalwarts of the market, And for a little bit of beer money, lottery ticket, if you will, you could buy a small put on a junk bond ETF like J&K or HYG. I mean, it's a direct bet on the credit spreads, and you're betting they're going to widen as fear takes over. Keep the position small. It's a directional gamble. I mean, look, there's always risk. Dimon could be wrong. This whole thing could blow over. I mean, maybe he's not. I mean, maybe he's just saying, hey, there's problems, but, maybe problems become big problems. Maybe problems get taken care of. Maybe get swept under the rug. But when the guy running the biggest bank in the world says, this stuff kind of looks a lot like what caused the problems in 2008, these are smart people in the room, and they see things and know things that we don't get to see. So I listened to it. And in a world of liquidity illusions, the only thing you can count on is relentless, beautiful, terrifying, irrational logic of the market. When the price makers become the price takers, somebody has to provide the liquidity. And right now, that's us. They're using our money to do these stupid investments that they did back during the financial crisis. They're chasing pennies in front of the freight train. So make sure you trade responsibly. Be careful out there. You can lose money. Let's jump in the disclaimer before we pop over to the charts and figure out what's moving today. Looks like we've got 60% on a drop so far. Make sure you vote. I don't see who votes what. You could vote anonymously. Welcome, everybody. Thanks to all my channel members like Dawn, Jim, Gayton, Tiger. I guess that's Darren, Sergio, Andrew, Mad, Steve, Svenborn, Terry, Dave, Scott, Gary, Ted, Pauline, Frank, Ed. Good to see everybody. And all the subscribers, thanks for being here too. Welcome to the show. If you're brand new, let me know in the chat. Love to welcome new people. So alts trading involves a substantial risk of loss. Past performance not necessarily indicative of future results. This presentation here is intended to be informational, educational, fun, and entertaining. It's not a recommendation to be buying or selling any financial instrument, including stocks, options, bonds, forex, futures, cryptos, treasuries. That's basically everything. So if you trade things, if you do it naively, 95% chance you're going to lose money. It's just the way the game works. It's the hardest game in the world. So if you want personal financial advice, if you're like, hey, I need to know what I need to do, there's people you can hire for that, but I strongly urge just to learn it yourself, because you're going to do way better at this game if you just learn how to play the game. And who better to show you how to play it than a guy that consistently makes money in the market? Check this out right here. That's my profit loss curve. Starting April last year. I grabbed this old Robinhood account, put money in it last year around tax day, and we're off to the races. That race is now getting to be close to $80,000. Pretty nice. Might be able to get there by the end of next week with a little bit of luck. So far this year, up almost $25,000. And all time, I put like $500 in that Robinhood account and lost it because I didn't like the way Robinhood worked and I couldn't understand how to do things all the way back in, gosh, what was it? Like 2018 when Robinhood came out. Had a hard time pushing the buttons right into 2020. It wasn't a platform I could operate very well as a trader. And then they've made changes along the way, and I refunded it here and started doing my turbo wheel strategy and beer money trades and trying to consistently just book some income every single day. And that's what's turned into this. Like, book a little bit of profit. Occasionally take a loss. Occasionally take a big gain. But more recently, I've just started trying to be profitable every single day and get some profit booked in the account. It was a little spottier back here. Now it's very consistent, as you can see. If you look at the last month, haven't booked a single losing day. Last 3 months, 1 losing day. Think about that. Over 60 trading days, and only one of those for me was a loser. And you say, well, did that loser eat up all your profits? Nope, not hardly. That's my 3-month profit right there. Close to $40,000. How's yours looking? You can let me know. This is not a big account either. This is like a $100,000 account. Yeah. This back here, when I started this game, when I started this account, refunded this account, I put about $75,000 in. Now, along the way, somewhere over here, I added 10K more. Somewhere in here, I took some out. Somewhere in here, I took some out. Somewhere in here, I added 1,000 back. Somewhere in here, I added 2K back. So what's the actual capital I'm working with? I'm not sure. The account's worth about 120K. There are some net open loss in there. I bought some stocks and they've gone down. I've got some CMG shares. I've got some DJT shares. I've got some DOCU shares. I've got some Chewy shares. And a few of these are down. I've got some HPQ, which is kind of break even. I've got some TSLL, a lot of TSLL. I got some CRCA, which is actually in the profit. And combined, these are down a bit. Like few tens of thousands of dollars. So where this should be like 150K maybe, I'm actually like banging around 120, 125, something like that. So yeah, HIMS is in there. I got some HIMZ, a little bit. What's in there? So there's plenty of stuff in there. And I just keep selling upside calls, bringing in profit, and doing the beer money. So this is actually coming up out. It's starting to dig its way out, actually. So of the net open loss, whatever the pullback was that we've been churning through for months, it feels like. I am a little bit tech heavy right now. All the freaking good stuff is all sold out. Like, it makes those big spikes on the chart. But this right here, we've just been churning. So I've just been selling options. We're kind of at the lower end here. We may take one more dip down before we rock out of here. I don't think this doesn't look like the top necessarily yet. This doesn't look like the big crash we're going to get yet. Now, if we were to dip this down, go rocking and rolling back up here, and then come back and break down, that could be the setup for the big crash. And it could take place later this year. We'll have to see what happens. This right here, low consolidation First move down, retrace. That looked very sloppy, kind of like an A, B, C flat. This, maybe a 1, 2, 3, 4, 5. I don't know. S&P had its highest high here, unlike NASDAQ that had its highest high back here. This one actually made a higher high and made lots of highs in between. But now we've retraced to the roadmap line right in here. Just a matter of time. Like, does this stop? Does it go lower? It's a good question. We're near a point where we could bounce. We didn't actually touch the cash index on the roadmap line. I kind of warned about that maybe we needed to dip just a little bit lower. Now the futures did touch. Trying to touch again. NASDAQ, it's been riding this for a little while and may need to go on down here. Russell, playing a little bit different game, but here it comes right for the roadmap line. Retest that breakout. Beautiful. So we're going to reset everything, it looks like, if we touch these today and be set for going higher. So be careful if you're bearish. This party may be over when we reset all three indexes here. Big tech, broad index, broad market index, and small caps. Oil still pushing higher. Are we going to get to that magic 100 test of the 618? Lots of people calling for it. UCO would be the way to grab a piece. But that's starting to be exponential. Be careful. Major resistance coming up right up here. 38. Cautious on that one. Iran could just play let's make a deal. And this come flashing back down. Gold. And for those of you saying that nobody's insuring the tankers, Trump said he'll insure all the tankers. Smart play or dumb play? I don't know. Gold probably coming back down, lower low. Be careful out there. It's got the setup for it. Probably be back down in the 30, maybe as low as 3,600. Could be as high as 4,400. Probably going lower than that low right there. That's what we need. Roadmap line coming in right here. And the ideal target right down here around 4,000. Be careful. It's set up. That thing is set up. Now, could it go higher before we actually roll off? It's possible. Anything's possible. We may actually, have a first move down, a little retrace, and then a bigger move down, a little retrace, and a final move down. Could last us out till late this month, next month, even May, possibly. Bitcoin came up shy of the target. This is looking a little sketchy. Overlapping. First move up. So this is looking like an ending diagonal for the C of the A. It's just been a sloppy freaking thing right up off that low. And watch out for one more pop. Big retrace. This could actually go deeper than I was thinking if we don't go as high as I was thinking. Because this is a diagonal here and this is all sloppy. We could come right back down a little lower than I was thinking. Then maybe we come up shy of that ideal 90 when we rally back up again. This B wave could happen faster. We may accelerate this whole thing. Instead of it taking out till June, maybe it all gets done by April, possibly early May, and we find ourselves back up here. Yeah, maybe we do this, and then we do this, and sometime in April we're up here, and then we embark on the big down, the 30 to 50K area target underneath this low right here, underneath that low. Got to get under that. to finish up this whole big correction. And the timeline that makes the most sense is that it would take till October for that to really play out, because pretty much every time we've done a big correction on Bitcoin, it takes about a year. It takes about almost a year. Right there. Takes almost a year. Right there. Takes almost a year. Right there. See the pattern? This one, the only one I know of that happened a little bit faster, but same big correction. $70 to 80% pullback. This one, if it follows the pattern, it's going to be a little bit smaller than everyone before. Percent-wise. That's why 50K might be the top, might be the bottom. But likely we're not done yet. This price action off that low is not incredibly bullish. It's actually, we could just dip off now, go cruising down there and make the low. That's possible. Maybe we don't get the rally back up. So Bitcoin is in this path. There's no reason why. You're not going to put any fundamental story to it. This is just price action. It's going to correct out. It's likely to do it until the correction, likely to last until October. If you're trying to be bullish on crypto, we hit the timeline for the top. We came up short of the ideal top, but we hit the timeline for the top within 2 days of what I thought it was going to hit. And then we started correcting. It's likely the correction continues through October, a year from when we made the top. Same on Ethereum. And this thing could go lower low. We could end up down here below 1,000. We didn't really do anything bullish here. This thing's kind of been in a big correction. And it's set for going lower. So be careful. Be careful, be careful. Even though we came up, scraped the prior high. Couldn't even get any kind of continuation and start right back down. This can go below 1,000. Dollar. Looky, looky, looky. Dollar's starting to pop. So dollar going up. Strong dollar puts downward pressure on commodities like gold, silver, platinum, even black gold. But right now, black gold rocking and rolling. Now, one thing that's interesting, if you priced oil in gold, this is an interesting chart. You take dollars out of the equation. Look at this. Oil priced in gold has been plummeting. And this is just a little blip. We're not even back up to the July highs. You say, well, it's because gold's priced so high and blah, blah. This takes dollars out of it, though. It's just the gold oil relationship. This is when you take oil and price it in gold. This is oil priced in ounces of gold. We were in an epically low point right here. Epically low. Well, it's the petrodollar. Except this is the petrogold. That's the oil divided by gold. This takes dollars completely out of the equation. Takes dollars out of this one, takes dollars out of this one. They cancel out. Interesting, right? Look how beat down that was. Went from a high up here all the way down in here. So oil's just put itself back. Now, where would this be if we came back up in here to 0.04? Or even back up to 0.06, 0.07. Oil, in terms of dollars, is going to go up quite a bit to get back to that kind of ratio. And if gold goes higher, well, it's an interesting ratio. NKD, this dipping on down, going to put down pressure on the U.S. markets. We could see a bigger retrace down here. This is a global liquidity indicator. It's the Japanese stock market. It's kind of an unwind trade. We were looking at the Kospi yesterday. I tried to get a short on this, but couldn't get it to happen. I canceled the order later in the afternoon. That 50-cent trade was up at like $3 in the afternoon. I was like, forget that. That was getting close to what I was trying to originally. I mean, that was like the original put spread was close to $3, $4. I was like, well, forget that. EWY was what I was looking to plan. Look at that dip back off. One reason why. This is probably coming on down here. Apple, back to the roadmap line. Let's see if this can hold. If it doesn't hold, break below this low over here. Probably coming on down to about 205. Amazon, still holding on to the lows. Want to see this break above the roadmap line. Fill these gaps right here. Fill in the first one. Roadmap line sitting in there. We got to fill the second one. Break above this. So we've got resistance here. Resistance here. Resistance here. And if we can get through all of those, return to the high is resistance. Expanding. 270, 280, possibly even 300. Google still looks like we're going to dip on off to the roadmap line right in here. Somewhere around that 280, 270, 260. Meta. As long as we're holding higher lows, this is set to break on out. Rejected the roadmap line, retraced again. We can get above it. Confirm above it. Then we're set for 1100 to 1300. Just kind of working through some stuff. Upside pattern intact. Now, if we break down below this low, no bueno. Not looking good. So this is a cautionary thing. If we start breaking lows, there's your first warning. Break them low. Second warning. Big third warning. This could crush on down. So right now it's set up bullish, but with the higher lows that we've had going for a couple months, if we start breaking lows, making lower lows, watch out. This is always something I warn about, like on a chart. Like if you sit here and connect up the lows and we start breaking the uptrend of lows, problems. Microsoft, so far, it really pushed the limits here. Really got down, dipped its toe across the line in the sand, and it started reversing a little bit, but we're not doing bullish things. We're not getting back to the roadmap line yet. We're not coming up, retesting from above. We're not doing this. This can lead to further downside, and we may go lower low than we were back here on Liberation Day. Despite all the AI, beautiful momentum and, cash flow, blah, 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 they're apparently the money that they're spending on AI data centers has people worried. A little bit. Apple, funny enough, Apple was like, we're good. We're not going to play this AI data center game. They've got like barely any money in AI data center stuff. Instead, they've invested in development of M5 chips that have local AI inference. They're letting everybody, they're letting all these other companies play the AI data center race, build these models and do the research. And they're like, you know what? We're just going to build some chips and put them in millions of people's hands. They can run all this stuff local, and we don't have to have cloud infrastructure. Different idea, different way to play the game. Why Mac Studios and Mac Minis are back ordered for like 2 months. If you try to go buy one now. NVIDIA sitting here on the roadmap line. We may dip on out. Right down here. Tesla below the roadmap line. As I mentioned yesterday, this indicates 370. Trip down to that would be almost expected at this point, maybe 368. We can break up through the downtrend highs here. That would change the tune pretty quickly, but so far not doing it. 370. In fact, I don't even have an alert sitting there, but I'm going to put one. Netflix popped up to the roadmap line and stopped. Next resistance up 108, 107, 108. And if we can get above that, we can set some upside, maybe 150, 145, 156. I do have some May calls on Netflix for going higher. Marvell. So I go pull gainers, things moving up $2 or more in the pre-market. Put them on the gainers list. Things moving down $2 or more. Put it on the decliners list. There's like 30 or something on the gainers list. There's like 120 on the decliners list. I guess it was 40 on the gainers list. And kind of sets the stage for the day. So those that said drop, well, you're not, you're just following along with the market bias. And say 24% expecting a dud by the end of the day. We'll check out the gamma exposure here in a minute. Let's flip through here, see if there's anything interesting. Shopify coming up to the roadmap line. If we can get up through that 618 at 150, sets up the upside there. That's what I've been keeping an eye on. Maybe one of the biggest trades of my life, percentage-wise, on Shopify. It's like 15,000%. Ferrari, this is one to keep an eye on. If we can hold this three-wave retrace here, break back up, this thing's probably going to new all-time highs. If we get below this low, though, we're probably coming down here to 300. It's just one to keep an eye on right here. Has the pop, three-wave. If we do any kind of retrace and stay below that, watch for a dip on down. If we break above 360, starts tipping the odds, we're going to come up through the roadmap line and go bullish. This is a potential bottom in place here on Ferrari. Another one that's kind of interesting for a potential bottom to be in place. Bank of America retesting this breakout. If we can hold on to it, turn back higher, this could actually go on a pretty massive run. CrowdStrike, look at that, beautiful. Funny. I drew these arrows on here a while back. We get up through that 465 area, 606 on the upside. VOO. That's just the S&P 500. EORU as briefed, coming back down pretty violently. If EWY goes to the roadmap line, this will probably come down here, take the entire move back from the breakout back here in October. This is why I was warning, book profits. FAS, Down to that 618 retrace. I really like that. This could, if this can hold here, that's a big if. Big if. If we can hold here, turn back higher, this thing could be set for a massive upside potential. Talking about maybe up here at 1,000. A 10xer. Conservative target would be like 270. Aggressive target like 1,000. And Owings Cornerware still coming back for the roadmap line. Too far, too fast, coming back down. ALM, and still haven't found a bottom. Adobe might need one more dip. Capital One. MasterCard shopping around. Visa shopping around. Capital One shopping around. So these are all doing a bigger retrace. This one potentially done here in this 290, 300 area. MasterCard potentially done already. See if this can reverse the tune. Or if we're going to get an extension lower in Capital One. I don't even have any subwaves yet. I mean, we paused at the roadmap line and kept on trucking. This could get more ugly in Capital One. JP Morgan, right at the targets. That can be the bottom. It's an opportunity. Let's see. We're coming up on, this month marks the end of the quarter, and then we'll have financial earnings. So what we're seeing is like this suck out right before we start seeing money flow into financials ahead of financial earnings in April. So we see this suck out, and then we see money flow into financials. Then it stops, and like just before earnings report in financials, we see money flow out, and that goes into big tech. It's just a cycle. And then that money disperses into other things in the market. But it's almost like clockwork that we see money flow. It kind of flows out of financials, then right back into financials, then out of financials into big tech, and then disperse through the market. It's kind of a cycle. If you're into money flow stuff, that's fairly reliable. And we usually see FAS rally into the earnings, at least a little bit. Doesn't always work, but it's like coming into June, into that July earnings, rallying. So that last week, and it happens like, September and October. Where's October? Yeah, this one sold off a little bit. Coming into December, into January, rally. Rallied pretty strong there. So does this one continue down, or do we get a rally? And this is a 3x magnifier right here. You could play something not 3x leveraged, but this magnifies the gains in the money flow into that market. NBIS, nothing. Look at that. Down to the roadmap line and just died there. AMD, looking for this to hold here. Could go a little bit lower. I have an ideal spot at 182, but this is time to start thinking about your position on AMD. If we're going to hold here and go higher, bigger upsides up here in 400, 500, 600. Reddit, probably going to dip on down. DoorDash. So it overlapped that low, which indicates we might be done, but it didn't close up there yet. So this may have just been a deep retrace here, and we go dipping back down 150. PANW potentially has the bottom in place. We can get the bounce. We could be up here at 300. And Datadog failed the breakouts. Right back in the chop that we've been in for a few years now. It's a volatile chop nonetheless. Boeing. Back to the roadmap. Back to the roadmap line. If we can hold here, turn higher, the upside should be up here. Hood. I think the bottom is in place here, or we're working on having the bottom in place here. Resistance roadmap line 618. Conservative target 170. Aggressive target 300. CRCA taking a little bit of step back. CRCO. Nice upside potential. We stopped at this roadmap line. That's why CRCA has paused. We may see a retrace before we pop through. HIM's just consolidating here. Maybe has a low, maybe doesn't have a low. Hard to tell. Checking out some of my stuff. HPQ. I have 22 calls sold against this. I got put at 20 and 2050. My cost basis is 19. This should be a long-term low. A, B, C. Big long-term low. Look at this. Beautiful dip. Move up off the low. Trace. The next move up on this one, if we can get going right up there. PLTR. Also, ideal bottom struck up to the roadmap line. It's kind of what I want to see Hood do a little more aggressively. We get up to the 618, which is right here at 173, 220, 230, 280 on the upside for the next extension. And if we match the prior run higher off of this consolidation, we could be looking at something much higher, like 375. All right, I got a couple setups. That one's sloppy. Potential bottom in place, move up, although that's just 3 waves. That gives me a little caution. This right here gives me a little caution that this may fail. Why? Look at the proportions here. First move up, retrace. Put that on the low. We didn't even make it to the 1.0 extension, where the first move up and the second move up were the same size. And then this is retraced deeply all the way back into this consolidation. That is no good. No bueno. No good. But the pattern's the pattern. And the upside 13. But this is low priced. It's under 20 bucks. And $1 below the low is 10% risk on top of that risk already. And this is the little reward. The risk reward is all screwed up. When the risk the reward is greater than 7-1, these tend to fail. So just more often than not, it's like once you get the risk reward greater than 7, the odds of failing seem to be much higher. Here's the high, here's the low. Very strong move up here. Very nice retrace. Here's the high, here's the low. Kicked off the entry right here. Target 34. Yeah, no statistics that matter. Grab it off the entry today. Target there. Stop, dollar below the low. 27.50. There you go. 2.6 for 385 risk. 264 upside. 385 risk. That's closer to 1-to-1. So reasonable. Now, this could take a while to happen, so be careful on that. Let's go dive into the SPY. See if we can read the tea leaves where we might go today. Yesterday, look at that. We poked, tried to poke out of the bottom of this. Came right back up in, right near the close there. Today, gapping down. See where we can read the tea leaves of the market. Figure out where this might go. Look at the gamma charts via bullflow.io. We got the Qs up first. Let's go back to the SPY. And wow, look at the big level up there at 680. So these are, we got a pretty good stacked level in. Wow. Pretty solid bubble. Look at that going all the way down. A little bit of fear in the market there. All the way down to 664. Kind of capped off with 680. So pull this up to 680. It's kind of where we gapped down from yesterday. And the bottom down at 664. That's kind of our range right there. The big level up at 680. Biggest gamma level on the field right now. Almost $800 million exposure up there. Could kick off a rally. 600 million down here at 670 though. Let's look at the levels. Where's the balance? Puts are skewed. Holy guacamole. We are heavily skewed puts, so that can result in a pop. We go with like 682 as my level. Actually, if we balanced out the puts and the calls. That's actually above the bubble. So if we get a pop today, we could see this might actually bust out of the top. Come up here for the pin. Kind of crazy. The bubble's capped in with 680, but doesn't have to hold. Since that's mostly put players. Just screw the puts, right? That's almost $1 billion worth of puts played right there. Rip it right back up here and close it for the day. 682. Screw everybody. All right. That's SPY. Don't usually put the levels like that, but hey, yeah. That's what the levels are showing. Could it go lower? Sure. That's possible. We'll look at the price action here in just a minute. And QQQ. Let's see what we got. Cooking. Hey, good looking. Probably should load this first. Let it load while I was moving the levels around. QQQ. Hey, thanks for being here, everybody. Make sure to tell a friend if you think anything I say is helpful, beneficial. I go through this stuff every day, try to figure out. Oh, there's no bubble. Here we go. Still no bubble. There's a big level at 600. Stacked all the way down through there, so put players got it stacked. 610 is gonna be the upside. Dang. I'm going with 595, 610 on the level on the bubble here. Actually, I'll go 611 to contain it. 595. Actually, 594. We could dip down just a little bit. Big level at 600. Which is basically right where that is. It's the biggest level on the board. And as far as where I would expect it to balance and screw the most people. Golly, look how much put players there are. I'm going to go with 605. If the market wanted to take the most amount of money from the most people, that may be where we hang out for the close. We've already visited that. Be careful on that. Let's take a look at so we could not break higher. We're back to a lower low. This may extend to, we may get a dip just a little bit lower. And we could extend it. It's possible, but it's probably going to be some support come in. So look for 66.90 on ES. That's SP 500 futures, not the actual cash index. Cash index, we need a dip to the roadmap line. If we didn't do it yet. Yeah, we didn't do it yet. So we need below 6,700. This may come back down after the morning. Whatever. We may get a little dip in here. Find supports. And then rally. As at cash. It's probably all about this S&P. And this is just going to keep churning right here. We could see a dip, but seems unlikely. A whole lot of green candles, a whole lot of, we're seeing some buying come in here. Starting to look prime for a pop, even though I'm not sure we can pop before we get a lower low than what we had back here in November. We're just churning in here. The other thing that comes into play, this is the, right now, if we dip down in here, this will be the lowest low. Markets don't tend to bottom on a Friday. Tendency. Like 90% of the time, S&P doesn't tend to bottom on a Friday. That invites continuation Monday through Wednesday of next week for a little bit lower low. And it just takes one little spike down there to satisfy this. Now, it's not always. We can pull up plenty of instances where it made a bottom on a Friday, but around 90% of the time, we will make a dip lower before we go higher. If we make it lower low, lowest low on the Friday. And this right here, so far, not really qualifying. Just tying. It's not really the lowest low. Even if we're talking a couple ticks, that's not really like a big flush out thing. We just don't typically do a big flush out thing on a Friday. It's just kind of not the way we end the week psychologically. So be careful out there. You might lose money doing this thing we do called trading. Looks like we got some stability though, based on the SPY and QQQ options. A little downward pressure, but maybe some stability. So be careful. Bet in either direction. We may not go do much until the OPEX on the 20th. And we could get a little flush and freak out some VIX before then. The big VIX OPEX coming up on the 20th. Seems to be climbing the wall of worry. If you want to bet on this settling down, your day for that to happen or start happening, March 17th. Why the 17th? Drop a little bit of gold on you here. The 17th of March 26. 26 options expiration calendar. See, this is straight from the CBOE. This is not like I made this up. March. See the 17th, blue, light blue. What does that mean? Last day to trade VIX options. Just VIX. Nothing else. The pink is options expiration day. That's the next day. But wait, I thought all the options expired on the third Friday of the month. Not VIX. VIX is a different critter. VIX doesn't even follow the regular indexes. Those regular indexes are on the green day. Right there. And they expire on the 20th. Regular equity options standard expiration. So VIX is a different critter. Even the VIX weeklies are a different critter. So be careful out there. Volatility could continue next week and stop dead on the 17th. And then highly likely we rally from the 17th through Memorial Day. Just a week. It's just a normal yearly cycle. Happens in the market. So be careful out there. I'll be in Discord. I'll be on Market Masters 11:30. Have a great day. See you later. Bye for now.